If you are using MACD, maybe you want to know the most profitable places to set your take profits and the safest place to set your stop losses. But how? Yes, this video is all about this valuable information when you are using MACD in your trading system. MACD, an acronym for Moving Average Divergence Convergence. I tested this indicator for 1,000,000,000,000,000 times. I tested MACD first by running a test to find out which combination of its parameters works best for the data I am using. And then I pulled a lot of statistics out of the signals it produced, and to be honest, I got super exciting results. It opened my eyes to a completely new way to use these financial tools. I was never positive about using any of these common old lagging indicators, but a while ago I had this client who had this MACD indicator in his trading system, and for solving his problem, this question came to my mind: how can I know the best way of using this indicator before we even create a trading system? So we always used to create a trading system, then optimize the system's parameter, and then try to backtest it and find the optimized whole. But now I learned we can actually isolate each component of the system and use statistics to uncover their secrets. The MACD indicator is considered an oscillator type of indicator and has been widely used for identifying two features of the price movement: trend and momentum. The MACD fundamentally relies on the concept of moving averages, which are initially calculated based on the price movements. The indicator consists of two main components, the MACD line and the signal line, both of which are derived from simple or exponential moving average of different lengths. Although it's possible to use a different type of moving average like double or triple or even volume weighted moving average, which is very unorthodox, but it's possible. If you want to see how this idea would work, I created this free indicator on TradingView with multiple type of moving average convergence divergence. I put the link below this video so you can have a look and see how this indicator would work. For computing MACD, we usually take the close of price data, the candlestick data, and we calculate two moving averages, and they should be in different lengths, obviously. Naturally, one of them has a shorter length and the other one longer length. We can call them fast and slow moving average for the sake of my own comfort. Then we subtract the slower moving average from the faster moving average to create the main component of the MACD indicator, the MACD line. The MACD line, it always moves around zero, and that's why we call it an oscillator, because it's always oscillating around the zero line. The next component of MACD indicator is called signal line. And to calculate the signal line, we use another moving average on the MACD line. We can add another component which is kind of optional, but there are some unique ways to use this element, and that's the MACD histogram. The MACD histogram shows the difference of the MACD line and its moving average, the signal line. One of the easiest and very common ways to use this indicator is the analysis of the MACD line's behavior compared to its moving average. Again, we are dealing here with moving average concepts. So when the MACD line is moving faster than its moving average, the signal line, it means it's suggesting potential upward momentum or bullish signal, and the opposite situation is potential downward momentum or bearish signal. And that's where the histogram becomes handy, because you can easily detect the state of these two lines and also see how much they are diverging or converging from each other. In that way, you can see the strength of the momentum. So when the MACD line crosses above the signal line, it's considered a bullish signal, suggesting that the momentum is shifting upwards. And conversely, when the MACD line crosses below the signal line, It's considered a bearish signal, suggesting that the momentum is shifting downwards. What I find personally fascinating about this indicator is how the idea of convergence and divergence recursively repeats throughout its various levels. Like in the lowest level, initially it's between those two moving averages, then it extends to the relationship with its signal line, which can be seen in its histogram. And finally, it involves comparing the MACD line movement with the price movement. This analysis is commonly known as divergence analysis. Well, I don't want to get into that right now. It's kind of a huge topic and there are so many sources out there to explain it in full details. But what I want to focus on is the strategies that they are using MACD as front end of their system. Simply for now, just the crossover part of the indicator, not the divergence analysis. So what I mean by front end is like whatever is in the middle of the strategy, at the end MACD is going to decide our entrance or our exit points. This is an example of one of the simplest and most common beginner level trading strategies based on MACD. Here we use an exponential moving average with a length of 200 to determine the so-called long-term trend. Essentially, this filters out many MACD signals. However, the MACD is what decides whether to enter or not, to exit or not. And that's the area I'm interested in. So I chopped my market data into pieces between every signal that MACD produced, and I traced the price movement and the MACD line movement. I noted down the price difference between these 2 points, and then I looked for the maximum amount of price movement in our favor, meaning the maximum potential profit we could take, and vice versa, I looked for the maximum potential loss we could face. I traced the price movement in these points and noted the MACD line positions at these points, and I gathered all these statistics to see how actually the MACD is behaving during market time. But before I run this test, I need to know which MACD settings had the best performance in the data I am conducting this research. So the result is telling me that this one had better performance based on the Sharpe ratio. But pay attention, these results are subjective. When dealing with trading systems, there are numerous parameters here and there, and these parameters depend on the data you are using, the security you want to trade, the time frame you want to trade. What works for Bitcoin might not work for Ethereum, and what works for Apple stock in a 4-hour time frame might not work in a 1-hour time frame. Different assets and different time frames can require unique parameters to be adjusted. For instance, let's say I want to trade Bitcoin and I prefer to trade in a 5-minute time frame. So I run this test on the last 5 years of Bitcoin data using a 5-minute time frame. And now I can see that these parameters statistically had better performance on this particular instrument and a specific time frame. After I know which settings I should use for MACD, I run the main test, and here is the result. So what you see here is a snapshot of every MACD signals in the last 5 years in Bitcoin, 5-minute time frame. I separated the signals based on longs and shorts. And what you see here is the drawdown or the maximum loss we could face, and these are the maximum profits we could take. I categorize further based on the MACD line's position at the entry point. So this is the maximum possible profit based on where the MACD line was at the moment when the maximum profit happened, which completely makes sense. For sell signals, for instance, you got here, and as the market is moving down, the MACD line is also moving down and goes further away below zero line. But in this chart, I can see all the best exit points according to the entrance point. So now all the maximum possible profit and the maximum possible loss of each signal aligned vertically based on the position of the MACD line at the moment of the initial crossover, meaning our entrance. Now I can see the majority of profitable ones happened when the MACD line was near the zero line. Another interesting fact is the most of my signals had this much drawdown. So maybe I want to put my stop loss around here to avoid getting kicked out of the market. This is also same for short signals. So I went further and picked the signals that returned more than a 3-to-1 risk to reward ratio, the signals that we are really interested in. But again, all are suggesting that when the cross happens in MACD, it's much better if the cross is near the zero line. I also filtered out the losing signals to compare. However, for a clearer comparison, let's count each signal vertically and visualize them in this way, so we can see the difference much better. So all these data are suggesting that signals happening near zero line are performing much better for both sides. And with this plot, you can see that for long signals, it's still better to be below the zero line. And for short signals, still better to be above the zero line. So now it's time to ask the most important question. What will happen if we apply this new knowledge to our simple trading system? So our strategy was to enter the market for long trades when the price moves above the EMA 200. Then we wait for a bullish MACD crossover to enter. For short trades, we look for the price to move below the EMA 200 and a bearish MACD crossover. And now I just add a new condition, which is I say the crossovers should be in a specific range. For longs, between -50 and 0, and for shorts, between 0 and 50. The result was kind of promising. For long signals, we had around a 108% increase in our Sharpe ratio. This shows that our system is picking much more accurate risk-adjusted signals now. For shorts, we had around 140% increase, which is in general, it's kind of an impressive improvement for such a simple trading strategy. For the future, I believe the next step would be cool if I investigate to see how the state of the previous signals influence the profitable signals. So as you remember, I've chopped my market data into segments between each signal. For instance, if I have a signal with minimal drawdown and very good profit, then I'm gonna analyze the previous signal. I'm gonna examine all the behaviors of each MACD component, and this time I would include even the height of the histogram, the difference between the MACD line and the signal line, as well as time, the duration of the previous signal. I aim to gather all the possible statistics about the state of MACD prior to the highly profitable signals.